Hello, hello, hello. My name is Troy White. I'm with Hoodoo Financial, and today we are talking more on the financial literacy topic, but some specific focus on financial psychology, investor behavior. So I'm going to cover some of the lies slash myths about investing that you probably believe right now. And I didn't even care to pick the top five, the five worst, or the five most important, because that'll take too long. But I just wanted to flush out this concept for you to understand that negative financial psychology is something we all deal with, but it's something that you don't know you have. And so let's dive into it. So thing about financial literacy is, and the lack thereof, it's going to impact your investment decisions and your actions, your investor behavior. So, like I say, your financial literacy, the amount you have, impacts it. So, if you have very little, if you are fundamentally financially illiterate, then your outcomes we can predict will be somewhat negative in relation to your investments. And if I say if you have low financial literacy, your outcomes are not going to be good. If your financial literacy is very high, you are likely to have taken advantage of more opportunities and made the right moves. Your behavior would have been more positive towards financial behavior, your investment actions, and so therefore your outcomes are going to be better. So it's not like magic, you know what I'm saying? It's just the way it works. And when we have been told lies, I shouldn't even call them lies, because when we are told, we are given messages about finance and investment that are negative, most often they are incorrect. And they are incorrect because they are preconceived notions about investing, preconceived notions from someone who has not mastered the art of making a dollar. And they telling you making a dollar is a bad thing. You might lose your dollar. Yeah, you might trip and fall when you walk down the street. So should you not walk down the street no more? Same argument, right? All right, so the lies that we grow up learning about, the myths that we grow up learning, that are embedded into our brains from our parents, and basically their psychology, especially when it's negative, is being implanted on the child. The child grows up with these same negative financial influences, is what I would call them. And it just doesn't work out good for anyone. So let's dig a little deeper. So let's talk about the five myths of investing. Actually, they're not the five. They are five. They're not the five best. They're not the five worst. They're not the top five. They're just five that I thought of, that I would use to make the point to you on how important financial literacy is. All right, the five myths. These myths impact our actions, our expectations, and assumptions about our own financial future. So it's important that we dig a little deep into some of these myths, and I want to give a rebuttal on them. All right, number one, investing is only for the wealthy. Myth, lie, false. Now, there's some truth to that, though. It used to be that it was only possible for the wealthy to really access the resources and get plugged in. And the technology that used to exist around the processing of stocks, bonds, mutual funds, especially even before mutual funds were a thing. But the technology required, intensive amounts of labor paperwork, etc. Well, now we're in a digital age, and things can occur faster, and everything's changed. So the barriers that used to exist and that would prevent you and I from investing no longer exist. So there are very few barriers. There's no. If you can hear me now, you have some electronic device. You are plugged into the economy enough to start investing right now. So because it's not at our firm, there are no investment minimums. There are many other firms that have that same thing. Some don't. But another way of stating this myth, some of the mentality that goes into it is, I hear clients say, I don't have money to invest with. They think they don't have. But they think they don't have money to invest with because they think that investing is only for the wealthy. And they think that until they become wealthy, they won't be able to be in this investment world. That's a myth. You literally can work at McDonald's or less and become an investor. And this is how you're going to improve your life. This is how you're going to go from poverty to prosperity. You don't have to already be rich to start investing your money, putting your money to work for you. Your money should be working hard no matter how much money you have. All right. Another thing that I hear clients say is, my paycheck is completely spent by the end of the month. I understand. And in part, it's that way because you don't invest. In large part, I might say, damn near in all of the reason that you don't have no more money at the end of the month is because you don't invest. And I could go into all sorts of details to explain to you why that's true. But I don't have enough wind in me right now. I don't want to go dive down that rabbit hole. But maybe I'll do a separate video. I've covered on that in videos, but I won't cover it now. But fundamentally, is because if you don't save and invest, when emergencies occur, you have a setback, and you never achieve goals because you never invested towards achieving those goals. And so not achieving goals means you never move ahead. You are always behind. And in America, we always live paycheck to paycheck unless you make it different than that. All right. The second myth about investing. Investing is too complicated for the average person. And there's obviously some truth to that. And me as a financial planning, financial analysis, investment management expertise, and several other fields of finance, you know what? It was kind of nerve-wracking to me to dive deeper and deeper and deeper into finance because it's mathematical. It's a lot of math. And, like most people, math, must be difficult. You know what? But for you as a client, for you as an investor, it doesn't have to have no difficulty. Why don't you hire an expert? How difficult is it when your pipes bust to change it? You could change the pipes under your sink. You could snake the drain. You could put up the sheetrock. You could do the painting. You could repair the screen on your broken screen on your cell phone, your iPad or something. You could do it. But how about you just go hire somebody else to do it so you don't have to make this your expertise, right? It's something that you need done, so you don't want to clean up your house, hire a maid, right? Hire, not a maid, but a cleaning person. They come in clean, it doesn't cost that much. And, so hire someone to do what you can't do. So I'm saying that, so hire a professional like me. And then it's no longer difficult. And I'm going to explain it to you. Part of becoming a successful investor is becoming financially literate. That is very important, especially working with a professional, because you need to be able to understand how to converse with the person that's working for you. You need to be able to have a very good understanding of what they're trying to do for you, and you need to be able to convey to them the information that's important for them to make the investment decisions for you. And so it's a give and take of exchange of information between the client and the financial advisor. And so the more that you are open to becoming financially literate, the better I am able to help you build your investment portfolio. All right, moving on. Uh, the third myth that I call a lie about investing that is very common: investing is too risky and dangerous. You know, the emphasis on that one is the word too risky, because there is a risk reward trade off. So it's how much return do you need? And then I'm going to tell you how much, some other parameters, but from that starting point, I can tell you how much risk you're going to have to absorb. So there's a risk reward trade off, and the thing is, there's also a risk in not investing. The risk is staying broke. The risk is your money being eroded away by inflation. So you got to be in it to win it. I can guarantee you'll lose. If you don't invest, your money won't work for you. You're only as good as the next dollar that you make. And then what happens when you can no longer make dollars? When you're an elderly person. And to achieve, the goals that you have for yourself in your life, you're going to have to invest. And what a lot of people, I would say most people do, is just remove the goals. So, if you don't have the money, you just don't do it. And they just these goals just stay as dreams, is what it is. They don't become goals because you're not willing to put forth the effort to turn them from dreams to goals, from goals to plans, from plans to actions, and actions into goal achieved. That's the route that's going to go. Okay. What you're going to hear a lot about on that topic, investing being too risky and dangerous. Well, volatility is really what they're talking about. And people believe the stock market is too volatile. What does that mean? Stock market going up and then going down, stock market crashes and things. But a proper investment strategy understands that that's just the nature of the market. The market does not constantly go up. And so people will tell you, or the mentality becomes, for an investor who is buying into these lies and myths, when there is a stock market crash, this investor will sell out in the market. They'll say, oh, it's going crazy, I better get out. So what this does is, it's part of it. Started with that myth. The fourth myth actually is that investments will go up in value always. They don't. They don't never take a smooth ride up. It's a rocky ride. It's a choppy ride. There's even been some stocks that fail and go out of business. So it is a possibility for loss for you to miss out on this company. But for the most part, the asset will rise and fall. It'll go up and down. So I can tell you that. So why did you jump out just because you get scared when the stock market crashed? What that means is, what a lot of people do is they buy high and sell low. But as you know, the only way to make money in the world is to buy something at a low price and sell it at a higher price. But if you buy the stock at $100 a share, stock market crashes, it goes down to 50 and you get scared, you sold it, and you keep doing that all the time, well, you keep buying high and selling low. And, and people get discouraged when that happens and they never invest again. And it's a detriment to you in your future and the achievement of your goals. In the future, meaning what I mentioned, you can't, you can't continue to live paycheck to paycheck when you don't even have a paycheck anymore. All right. So, So the thing about that is, do not try to time the market. You have to be, don't think that it's going to be a consistent climb up. It's going to be a rocky road. So don't time the market trying to jump in and jump out. You have to have you have to have a dollar cost average strategy. It's really, it should include that. Dollar cost averaging is where you take advantage of market volatility, where you don't have to be. All of these myths are cured by dollar cost averaging. The fifth and final myth: you should only invest in what you know. False, because you don't know enough about other things. Because for one, you have to have a diversified investment portfolio. So you only know specific things. You're not an expert in everything. So are you an expert in all electronic devices? Are you an expert in all cars, in all electric vehicles, in all electricity providers, in all oil refineries? We need to have a diversified portfolio in different sectors, different companies, different industries. And so it's fun, it's cute to invest in. The kids are buying squishies now, whatever that would be, right? Let me invest in squishy. Well, that could be a fly-by-night thing, So do your due diligence, your research on every investment. But, invest in things well, yeah, that is not false, but don't only invest in things you know about. You have to expand your understanding. And that starts with financial literacy, financial planning, and building an investment portfolio. So portfolio investing is the strategy. So all of these 5 myths are cured by a dollar cost averaging strategy that for a client who is building an investment portfolio that is based on their financial planning goals, and they are they're embedding an emergency fund in their investment strategy, and they are consistently trying to invest more as time goes forward. But once you begin your investment strategy, your dollar cost averaging, you never stop. You will never stop investing. So you might start investing $100 a month on the 5th of the month. Right now, for the next month, don't ever stop doing it. The only thing you do is increase it from 100 to 125, then 150, then 200, then 250, then 300, then 350, then on and on, as much as you can ever handle. And then over time, you are achieving goals, and this money that you are saving and investing in is being spent in a money making process cycle, a cycle of assets. Meaning, you're investing in 3 areas: the financial markets, real estate, and yourself, meaning entrepreneurship. And so as you make money in all of those 3 categories, they continue to circle around, and you're building a money making machine that you can pass down to your heirs. Hey, that's generational wealth. That's what we just talked it through. So these 5 lies will prevent you from building generational wealth. So these lies are: investing is only for the wealthy. Lie. Investing is too complicated. Lie. Investing is too risky and dangerous. Lie. Your investments will always go up in value. Lie. You should only invest in the things you know about. Lie. So those are not lies. They're just myths that, are embedded in our brains sometimes, and they are negative, and we need to combat them. So anyway, thanks for listening. Please like, share, subscribe. I'll leave my contact information in the description. If I am in search of more clients, so if you need help building your investment portfolio, we can help you put that portfolio together. We have online investment accounts. We're a digital investment advisory, so we can meet over Zoom, over Google Meets, over telephone. We're going to meet and discuss in various ways. I do workshops on a regular basis. I will be inviting you to those workshops as well. So as a client, you will become financially literate. You will engage in financial planning. You will have an investment strategy, and you will build an investment portfolio. Thanks for listening. I hope to see you in the next video. Holler.